Today's Ben with Benefits is brought to you by Pantera Advisors. One of the trickiest things about managing client assets is the fact that 401k assets are held away. There's nothing you do to manage them. Pantera is a fintech company on a mission to help the millions of Americans retire by enabling better 401k portfolio management from their trusted financial advisor through a secure client permission platform that's seamlessly integrated with the leading technology tools. Advisors using Pantera can deliver enhanced, more holistic investment management that can drive better outcomes for clients. Pantera's enterprise-grade security lets advisors view and rebalance client 401k portfolios while also preventing access from those accounts to keep personal data protected. To learn more, visit pantera.com/Ben. That's pantera.com/Ben. Welcome back to Ben with Benefits. Josh came up with that name, which I kind of like. According to the Federal Reserve, 70 billion or so members of the baby boomer generation now control $80 trillion of wealth. 10,000 of them are retiring every single day between now and the end of the decade. Millions are already retired. I think we had 2 or 3 million that retired early because of the pandemic. They're the biggest, wealthiest generation that's going to live the longest in history. So this is like a tidal wave of opportunity as far as I'm concerned for financial advisors. Joining me today to talk about this opportunity, Christine Benz. Christine is the Director of Personal Finance and Financial Planning at Morningstar and is the author of the new book, How to Retire, which is excellent. So you do a great job in the book with the help of some heavy hitters in the retirement space of outlining the various challenges to retirement planning, all the different variables you have to think about. What do you think the biggest challenge is in the years ahead for financial advisors when it comes to managing that process on behalf of their clients?
One of the big ones, and it's really kind of perverse to even talk about it because we have so many people in our society who are quite undersaved relative to what they need to have a fruitful retirement. But this whole permission to save problem has come on my radar in a big way that people, clients who have been good savers and have amassed significant wealth in their investment accounts have a very difficult time switching into decumulation mode. And many are inclined to underspend relative to what they could do. And, they might say, well, no harm done, that I'll leave funds for my children, my grandchildren, charity, whatever. But I do think that if advisors can help their clients spend more in line with what's possible for them, that they can do more lifetime giving. They can certainly enjoy their retirements more. So I think that is one of the big challenges that I hear again and again when I talk to financial advisors who work in this space. Yes, they have clients who they have to work with on the overspending, but a bigger problem does seem to be this underspending issue, and especially underspending in the early years of retirement when we know people are healthy, that may not last forever, and really lighting the fire under clients to get them to spend appropriately, I see as a huge challenge.
So I've been in the RIA industry for about a decade now, and I have to admit, this is by far the biggest surprise to me, how hard it is to make that psychological shift from being an accumulator and a saver into a spender and then that withdrawal. But it makes total sense because you kind of, a lot of people put it on the glide path and automate their savings and build and build and build, and you're taught to cut back and cut back. And I do think this is the biggest hole in the personal finance space is no one really teaches anyone how to spend. And it's really scary because in retirement, we know about all the uncertainties. We don't know what inflation is going to be or what the returns are going to be in the market. We don't know how long we're going to live. There's this longevity risk. So I understand why people hold their money close to the vest. And you get these people who say, like, listen, I never want to touch the principal. I only want to live on the income, right? And you hear these things. And so it's funny, one of the things we do, we have a whole Slack channel of our advisors sharing wins from clients. And they send pictures of, hey, I talked this client into buying the convertible or getting taking their family on the cruise around the world or whatever it is and celebrating those moments. And I just never really put in my head like, oh, you'd think the math is the hard part, but it's the psychology that's the hard part.
Well, 100%. And I often reference mentally this chapter from my own life when my husband and I were just buying our first house. And I think it was my dad's first year of retirement. And he and my mom gave us an additional padding for our down payment. And that I'm sure elevated his retirement spending above the level, that might have been considered a safe withdrawal rate. But what a phenomenal gift, not a huge sum in the scheme of things. And in hindsight, like a much smaller amount than we eventually inherited from my mom and dad when they passed away, but a much more impactful gift. So I think that there's sometimes like this unfortunate sense that, well, all spending is profligacy or something like that. But actually, that spending might be giving, helping loved ones make that home down payment or pay off student loans, things like that, that you might need to mull over earlier in your retirement will probably be more impactful for your children than inheriting money from you when they are, 57 or 60, which is what the data suggests is the age when most people do inherit funds from their parents.
I like that mindset change too of it's not just spending on yourself and
Right.
going on crazy trips, it's spending it on experiences or with people that you love so you can see them enjoy it. Or if you don't have that, then it's giving it away to charity or something where you can get some peace of mind out of it and sort of get yourself over that hump. You also talk in here about the retirement smile. It's funny how many smiles there are with these things. Like you hear about the
Yeah.
happiness smile, right? You're happy early in life, then it dips into middle age, and then
Right.
you get happier at the end of life. And I guess retirement spending is kind of the similar takes a similar path. So in your 60s and 70s, you're probably going to be spending more because you're healthier. And then that slows down maybe in your late 70s, early 80s. And then it ramps back up again for healthcare. And I don't think enough people take that into account of how flexible you have to be in retirement because again, the saving thing for most people is very automatic, right? I'm a big fan of automation. So are you. You automate your savings, your retirement contributions, your investing, and then you set it and forget it. But retirement is not that easy, right? There has to be much more flexibility. So what did you discover about that process of it it's hard to automate retirement?
Well, absolutely. And withdrawal rates, how much you can spend per year. There are these rules of thumb, and I, often hear individual investors repeat them back to me that, oh, I can spend 4% a year, right? And when no, that's not what the 4% guideline is. It's actually sort of inflation adjusted spending. So you would take like 4% in year one and then inflation adjust thereafter. But people misunderstand that time and again. But you're absolutely right, Ben, that when we look at the data on how retirees actually spend, and my former colleague David Blanchett did this work where he examined retiree households over the life cycle and found exactly the pattern that you talked about, where they spend more early, spend less throughout the retirement life cycle, and some, but not all retirees have higher healthcare costs, especially long-term care costs later on. So helping clients understand that spending should be flexible because it naturally will ebb and flow with the life cycle, but also you do need to factor in how the portfolio has performed ideally. So you would be, using portfolio performance to adjust withdrawals up in good years like 2024 has been so far, and potentially down in a poor year like 2022, where conventional stock and bond assets didn't deliver. So ideally, that retirees would bring that flexibility mindset into spending, and I think advisors can help coach them on that.
So I really loved the setup of your book where you had an interview style with experts, and then you shared your thoughts in the introduction and the conclusion. And in your chapter with Wade Pfau, who's kind of a spending and saving expert, he talks about the fact that retirement planning is still relatively new. So he says he thinks it was kind of born with the 4% rule in 1994 from Bill Bengen, and it's hard to wrap your mind around the fact that it is still new, right? In the past, not that far back, your retirement plan was you died pretty much, right? I think the numbers were in like the late 19th century, 95% of people 55 and older were still in the workforce or something, right? So their retirement still is a relatively new concept. So there's not a lot of history here. You don't get a ton of chances at it, right? You get one chance to go through it. You don't get to practice and take some practice swings. So what are the areas that you feel that we're still trying to figure out? Or do you think that advisors and experts have kind of got this stuff down at this point?
Not necessarily. One area, and I think this is mainly driven by individual investor behavior, client behavior. There still is that anchoring on wanting to subsist on current income. And some advisors just cater to it where, they'll focus on dividend paying stocks or MLPs or, whatever else is going to kick off the desired amount of income. But I do think that there's more work to be done in that area. The past couple of decades disabused a lot of, I would say, many sober financial advisors of creating portfolios around current income. But I think that mindset is still alive and well, and it, just tends to lead to suboptimal portfolio positioning. That was one of my impetuses to work on retirement planning in the first place, is that I would often meet these individual investors and they'd kind of they'd show me what they had cooked up in the interest of, generating whatever income stream they were looking for. And so I do think that, we're seeing more investors comfortable with a total return strategy, but I think there's more work to be done there. I would say that's a huge area where advisors can work with their clients on the education.
And the hard part about compounding is that it's really backloaded. And so it really starts to matter more as your balance gets higher, right? But as your
Well,
balance gets
exactly.
higher, maybe your risk profile changes. And so I tend to think that portfolio management matters even more during retirement than it does in the accumulation phase, because you have to consider, inflation and beating inflation, but also figuring out how to draw it on your portfolio. So any good insights into like asset allocation or investment strategies to survive retirement? Are people thinking about using more approaches that force you to spend down and have distributions as opposed to the traditional 60/40?
Well, a huge concern when you think about retirement portfolio construction is just sequencing risk and how you will mitigate that risk of coming into retirement and someone faces a really crummy market environment, either for the stock market or the bond market, or, frankly, even a big inflationary spike early in retirement. So I've come to be a big believer in, kind of the bucket approach. But the basic idea is that you're building a runway of roughly 10 years worth of safe portfolio cash flows. You will not necessarily draw down upon the portfolio in that way. If markets continue to be good, you're probably just harvesting appreciated equity securities. But I think that approach makes a lot of intuitive sense. And I think even for advisors who aren't using a bucket type strategy, I think it's a phenomenal visualization tool. If you're using any sort of balanced portfolio, here's why. Here's sort of the kind of mental accounting system that we're using to back into the portfolio that we're recommending for you. I just think it really works behaviorally. So I'd like to see more of that. Other people, Bill Bernstein, for example, I interview in the book, is a little bit more of an iconoclast, where he would argue people should build a tips ladder and spend it down and maybe have some sort of an equity kicker at the end. But unless we are addressing inflation risk front and center with that portfolio and basically locking down spending needs, we're not really doing our job. So I wanted the book to have a bit of a divergence of opinion about how to construct retirement portfolios, because I'm not sure there's any one way to do it.
Yeah, and I do like your mental bucketing thing. I'd like to tell people if there's a 60/40 portfolio and they're spending 4% of their portfolio, you have 10 years worth of current income in your portfolio to see you through something. You also talk about the Michael Kitce's study in the book about maybe you front load being conservative at the beginning, because the sequence of return risk is that if you have an extreme bear market early on, that can really screw you up, especially if you're selling your stocks. You don't want to be selling your stocks into a downturn, especially early in retirement. The one risk I think that poses for advisors is you make someone more conservative early on and they miss out on a period like the last 3 or 4 years where there's a huge bull market. And I think that's the hard part for advisors is balancing that, you know, what's going on in the market and that people getting FOMO or whatever and seeing big returns versus no, this is a risk management tool. And I think setting those expectations is key for advisors when working with clients.
Yeah, no, absolutely. We have worked on this safe withdrawal rate research for the past several years on our team, and year after year, basically the highest safe withdrawal rate corresponds with kind of a balanced portfolio. It's not really alchemy, but Yeah, I think balance is the key. The tough sell today, in my view, is getting clients to de-risk portfolios appropriately. I don't know if you have this conversation, but I feel like I have it with individual investors all the time, where they have had such a great experience with equities that getting them to have anything like a semblance of, a stake in bonds and cash really is a very tough sell. So I think that's a challenge that advisors confront
That makes
today.
sense. The market changes your perception of risk based on how it's performing. So the
Definitely.
the estimates I've seen over the years are that the average age of financial advisors is something in the high 50s, early 60s. I think I've seen like 58 to 62 for the average advisor. So many of the advisors who are currently serving clients are themselves going to be retiring in the years ahead, right? Now I think there's going to be some advisors who stick around because this is not exactly backbreaking work, right? They're going to have junior advisors running for them. Maybe they stay until their 70s and sort of continue to bring in some money. But do you think that the industry has the bandwidth to handle the massive need for advice in the years ahead? Because there are going to be people in the years ahead who just decide like they need advice and they've never used an advisor before because retirement is so much more challenging.
Well, definitely. And I do think we'll see more experimentation I don't want to call it experimentation, but I think we'll see more efforts to systematize retirement decumulation because, frankly, and advisors might not love to hear me say this, but the answer can't be for every single human in this country that they need some sort of bespoke advice. We need to automate decumulation in the same way that we have done for people who, get into a 401k plan, have no idea which investments to choose. Well, that's basically now turnkey for people in that situation. I think we need to get closer to retirement decumulations. Solutions for people, especially in the workplace, where there's so much that's suboptimal about the way that we do it now, which is, you're 65, here's your money, go figure it out. So I expect to see and I know the industry is working very hard on this, but I expect to see more innovation in that area in the years
Do you
ahead.
think that the younger and more middle-aged advisors actually have a leg up on the competition in the years ahead? Because they can say, "Listen, I'm going to be here for the duration. You're going to have 2, 3, maybe 4 decades in retirement. Your advisor is going to retire in 5 years, and they're going. Then what do you do?" Do you think that that's because I know a lot of younger advisors think they're at a disadvantage to gray hair people, where they're saying, I don't have as much experience, but is that longevity actually going to be helpful to younger advisors in the years ahead?
If the clients are thinking ahead, absolutely. I mean, at a minimum, even if a client's primary advisor has been a more senior person, I think you'd want to be looking at, okay, what's the bench here? Because I need someone to help see this through for me. So yes, absolutely.
So there are many clients who are perfectly content to outsource to an advisor. We have people come to us and they recognize the need for an expert or they don't have the time or inclination to manage their own assets, right? They'd rather do something else and they're not interested in this. But working at Morningstar and dealing with the bogleheads over the years, that there are many DIY investors who love this stuff. And they read all the books and the research and they follow the podcasts and they check everything and they know and they've accumulated their own wealth. But then they get to retirement and now they have to start thinking, well, maybe I do need some help. And maybe it's because I need more expertise in estate planning or insurance planning or taxes. But also there's that key person risk of I'm the one usually in a relationship. I'm the one who's managing the money. My spouse or my kids don't really understand what's going on. If God forbid something happens to me, I need someone there to take care of it. We've had a lot of those conversations over the years. I've talked to a number of people who say, I'm good managing my own money, but I have a letter in there saying, talk to Ritholtz Wealth if I pass before my wife, whatever. So how do you how do you tell advisors to deal with this DIY group? Because I think you're dealing with a totally different animal in terms of client, where this person going, listen, I know what I'm doing. I'm smart, but I recognize the need for an advisor. How do you help transition those kind of clients? Because I think that's a huge opportunity in the years ahead for people who haven't sought advice just yet.
Well, absolutely. And in fact, Carolyn McClanahan was at our Bogleheads conference this year, and her session was called when a DIYer needs to stop DIYing, because this is something that I think the Bogleheads types really need to be thinking about. Like, forget estate planning, that's a separate thing. What's the succession plan for this plan? You might be the most investment savvy person in the world, but what is your backup plan here? And I think maybe a starting point is for advisors who want to help people in this space is perhaps different business models might be more appealing, because that is a very much a Boglehead's ethos, like trying to limit your all-in costs. And so if you can potentially do like a retirement readiness sort of service, something like that, where it's not an ongoing stream of the client's cash flows, or some creative solutions like that to bring them on board, and then thereafter you can engage with them on kind of an as needed basis.
Right.
I think Bogleheads would be more receptive to that kind of thing.
Yes. They probably prefer frugal, not cheap, right? But they are definitely
Exactly.
cost conscious. But I'm obviously the biggest question almost everyone asks, and there are some people who have so much money they're never going to be able to spend it in a lifetime. But most people that you deal with as a financial advisor, their biggest question is, am I going to be okay? Right? That's the one they really want to know over all else. Am I going to be okay? Is this money going to last me? Is my family going to be okay? So after all this research you've done and talked to these experts, what do you think the best way to answer that question is for financial advisors dealing with clients? Because we're all dealing with the same unknowable future. There's the same uncertainties. You can't really give someone 100% certainty with these, but how do you feel that you can best give someone that answer of, yes, I think you're going to be all right if you do A, B, and C?
Right. I think talking through the potential risk factors. And so, the elephant in the room in the realm of retirement planning is long-term care risks. So you've had a lot of people coming into retirement who have decided not to purchase insurance to address long-term care risk, but in the meantime, they have this huge looming fear that all of their assets will be depleted at the end of their life to pay for long-term care. So it seems to me that you look at risks like that one by one, and you actually say, well, here's what we will do. And, maybe I become a big believer in the idea of kind of for the self-funders of long-term care, that you're hiving off a portion of the portfolio and basically saying it's here. If we don't use it for long-term care, it'll be available to your children, grandchildren. If you need an excess of what we've set aside there, that's where we maybe will use home equity or some type of reverse mortgage. So I think you get quite granular about what the risks might be, what not okay might mean, and talk about how the plan would address those risks if they were to surface.
You mentioned the reverse mortgage thing. That's always interesting to me because the majority of the middle class, their biggest financial asset by far is their house.
Right.
And I don't think many people even think about their house in terms of a financial planning tool. And that's where most of their wealth is tied up for a lot of people. Where do you fall on the reverse mortgage thing? Because for a lot of people, that could be a huge source of liquidity or cash for them to spend in retirement that they're just sitting in and it's doing nothing for them.
Absolutely. And this is particularly important in very high cost parts of the country. I was speaking to a group in San Diego a couple of weeks ago, and this was a top of mind consideration. These people have a lot of housing wealth. Their portfolio wealth might pale in comparison to what they've built up in their homes. So I am not allergic to reverse mortgages. I talked to Mark Miller in the book about them. They've gotten better over the past couple decades. There are more consumer safeguards. I think that there is a lot that's suboptimal about people dying with housing wealth when perhaps they've short shrifted their own standards of living. So I think that they should be part of the toolkit, especially for people with pretty tight financial plans in retirement.
And I'm not an expert on those by any means. I've read some books, and we have someone on staff who actually has dealt with a number of clients in that. Those things are not easy to understand. So I actually think that an advisor can do a very helpful job with their client understanding the pros and cons, because those reverse mortgages are kind of complicated to understand.
100%. And even if the advisor isn't credentialed to help with those, identifying some external experts to bring on board to consult if that seems like an appropriate source of funds.
So we've talked a lot about the psychological components of retirement. But someone in your book, I can't remember who said, like, listen, sometimes math has to be part of the equation, though, too, right? Some
Yeah.
people have that part of their brain where they're all math and they're all spreadsheets. Other people, it's more the squishy stuff. It has to be a little bit of both. So talking to clients and prospects and like readers of my blog, I know that figuring out the right withdrawal strategy can be nerve wracking and something a lot of people are trying to set themselves up for. I think everyone kind of knows about the 4% rule at this point. But after a lot of your findings, I mean, do you think people need to be a little more flexible in their spending rates? Because judging by your retirement smile thing, couldn't you say advocate for maybe that first 10 to 15 years of retirement, cranking up the spending percentage because you know it's going to go down after that when your health might not be as great? Like, do you think some of these spending rules are actually too conservative?
Oh, definitely. So the 4% guideline in many different market environments will lead to a significant balance at year 30. Maybe that's what someone wants, but maybe they
Right, you'll
don't.
end up with more money than you expected,
Right.
right?
Right. It's effectively built for a worst case scenario. And I thought in the book, John Guyton had a nice metaphor for this whole thing where he said, the equivalent of 4% is you're taking off on a road trip. And I tell you, you have to go the same speed the whole trip because you don't know what weather conditions will prevail. You don't have lights on the car, or windshield wipers or anything. And you'd be like, oh my goodness, well, I'm going to go 10 miles an hour because I don't know what the future holds. And his point is that, well, your car does have windshield wipers and headlights, and that is the ability to kind of adjust as you go along, as you set out on retirement and you set out on this spending journey. Well, you can pick your head up and say, oh, it's raining and I think I need to tap on the brakes. So I thought that was a beautiful metaphor for thinking about this superpower that people have with respect to retirement spending, which is that they can pay attention to current market conditions and potentially spend a little bit more or a little bit less based on what's going on. And the whole thing about the underspending early on, I think, is super important. That these are people's healthy, pent up demand years of retirement. Those are phenomenal years for people to enjoy their lives to the fullest, and that might call for spending more in those years. In our retirement income research that we've been working on, we found that someone who wants to use kind of a fixed real withdrawal in retirement could spend about 5% initially if the assumption is that their spending will kind of trend down throughout the retirement life cycle. So people should definitely explore different variations of the 4% guideline, but because I think even though it's a great rule of thumb for people who are like 10 or 20 years from retirement, when you get closer to retirement, you need to put a finer point on it.
I think it was Jonathan Guyton in the book too who said that what they've found is typically, let's say the inflation is 3%. Inflation for retirees is actually more like 1 to 2%. It's not as high as the rest of the population, which kind of surprised me because people
Yeah.
are so worried about healthcare. Why do you think that is?
Well, one of the biggies is that retirees are much more likely than the general population to own their homes.
All right.
And that tends to be a really nice sort of inflation mitigator if you're not dealing with housing inflation. So that's one of the big factors. They also, what we see is that older adults are less affected by energy costs because they're driving less as they age. So a couple of factors, but housing, I believe, is the big one there.
See, I think for my retired father, it's clothing. He hasn't bought any new clothing in 20 years, so that's his biggest inflation hedge. So you talk to all these retirement experts in your book, and you share some of your own personal stories. After going through all the research and talking to these people over the years, what have you changed your mind about the most in terms of what you do differently for your own retirement planning?
So, a couple of things. One is this idea of phasing into retirement. I have come to be a huge believer in this for people who can do it. I think we have to recognize that there are a lot of things that many of us, not all of us, but many of us get some really positive effects from work. So, structure, relationships, a sense of identity. So I think that has been one huge thing. I've come to believe that retirement is kind of a hard stop is not a great model for a lot of people. For people who have a job that they, like some components of, they should continue to try to do those things longer.
I
And I've
liked,
been,
sorry to cut you off. I really liked the example in your book about the person who decided to keep working, but twice a year take a huge vacation, right?
right.
Because that's what people want to do in retirement is take vacations. And so he increased the vacation spend, but kept working, and that ended up kind of covering those costs.
Right. That was Jamie Hopkins. And as a side note, the retirement contributions that we make when we're like over 60 do not do a lot for us in
Right.
terms of, compounding the tax benefits. They're just less the additional amounts that we're adding. So if actually spending a little bit more in those years leading up to retirement helps keep you in the workforce, well, that's the greater good for your financial plan. And then there might be also some, happiness benefits there as well. So I love that idea of people phasing into retirement. On the other hand, I know that there are some people who might say, well, I hate hate everything about this, in which case, quitting as soon as possible and thinking about what you'll do next is really important. That's not good for anyone to keep doing a job that
Yeah, and
that you loathe.
I think that's what I like about your book the most is that it really drives home the point how circumstantial this all is and how personality driven and your preferences and taste, where there's not one right answer. Unfortunately, it would be easy.
Right.
Retirement plan would be easier if there was one right answer, but you and the experts you talk to do a really good job of looking at the trade-offs on all this stuff: saving, spending, accumulating, withdrawal strategies, all that stuff. So the book was great. It's called How to Retire. Advisors should read it and then maybe buy a bunch of copies for their clients. Check out your work at Morningstar.com, correct?
That's right. Thanks, Ben.
Yep. And if you're an advisor, remember to subscribe to our newsletter at advisorunlock.com. Thanks to Christine for coming on, and we'll see you next time.
Thank you so much.